Hello.
Assalamualaikum.
Walaikum assalam. How are you, Zen?
Fine.
Doing well. Are you ready? Are you ready for us to begin?
Yes.
Okay, perfect. So then a little bit about myself first. My name is Moaz Zarouj. I've been teaching accounting for a couple years now. I have a background in accountancy and finance. I also am a part qualified ACCA. I've yet to take my last exam for ACCA. And like I said, I've been teaching for about 2.5 years now. Uh, I would love to know a little bit about you, your background with accounting. How good are you?
I have left accounting in the first year of A levels.
Okay.
So I'm in second year now. So I was the teacher I had was not able to let me understand the subject properly. So I had to leave the
Okay.
subject in the first year exam.
Okay. So you have not taken so you're going to take the AS level exam, right?
Yes, in the January or November.
January or November. Okay, makes sense. Makes sense. We'll see how quick we can get through the syllabus, and it will largely depend on how much time you put in the practice questions.
Okay.
And if you put in ample time and you work amply hard, you can get a good grade. What sort of grade are you targeting? Do you have some grade in mind?
Above C.
Above C. Oh, I think you'll be able to manage that. Okay. Okay, sounds good. Okay, I'm going to share my screen. Let me know when you can see it.
Okay.
Yeah, so is it up, the screen?
Yes.
Okay, perfect. Okay, so the way we will conduct today's lecture is I will guide you a little bit about what accounting is, what an accountant does, what is the main aim of accounting. We'll get through all of that. We'll try to understand the steps which are involved from the first step of recording a transaction to the last step of preparation of financial statements, which is the main objective of any accountant. And then at the end, I was hoping that we can discuss the syllabus and the paper pattern as well in this first class. Does that sound good?
Yes.
Okay, cool. Okay, so basically, okay, what sort of idea do you have of accounting? What do you
Like
understand from accounting?
the thing I've learned for myself, like the first chapter, accounting is
Mm-hmm.
analyzing, recording, and showing the statement of what you have entered during a transaction.
Right. Makes sense. So basically, if we look into it literally, so basically, accounting is the process of, like you said, recording, summarizing, and analyzing transactions. And then presenting them in an understandable manner. Then all of this might go, over your head. You'll get to understand more of it as we progress through the lecture. So basically, it is very basic. First of all, you need to understand that the first step that let us first just get to the steps, and we'll come on to this literal definition. Because if you understand the steps, then you'll understand what the definition stands for. So basically, there are 5 steps. Whenever we do accounting, we have to do these 5 things. So the first thing that we have to do is recording transactions. You record the transactions. How you record them, we'll get to that. The second thing is that, actually, you can stop me anytime you're confused about anything, Zam, in between.
Okay.
Okay. The second thing that we do is we prepare the books of prime entry. Now, don't get confused by all these, big words. We'll get to all of this. I just want you to get the big holistic picture of why actually you are studying this subject, and then we'll get to the nitty-gritties later. The third thing that the accountants do is that they prepare the ledgers. Ledgers are also called T accounts. The fourth thing that they do is that they prepare the trial balance. And the last thing which they do is they prepare financial statements. Now, the good part about accounting is that if you have done this first step correctly, right, you have done 45% of all that you're going to do correctly, which is why your main focus in the beginning should be on how you are going to correctly record the transactions which are being put in front of you, right? So this is 45% of all that accounting is. Step number 2, step number 3, and step number 4 is basically the information collected from this step number 1. You will have to put that information in different formats in the next 3 steps. Of course, there are rules, there are formats, and all of that goes along. But essentially what you're doing is, once you have done this step, all you're doing is taking the information that you received from this step and then, putting that only information into different formats. And you will be done this step number 2, step number 3, and step number 4. And then once you have prepared your trial balance, you will see this in the questions that we will do later as well. Once you get to the trial balance, then you have to prepare the financial statements. Now, I think this is 45%. All of this would be around 20%. So that's 65%. And the remaining 35% is the preparation of financial statements. So this is basically the main aim of any particular accountant. Now, what are these financial statements? Do you have any idea what financial statements are?
No.
Okay, so let's get to that first. So every company in the world, whether it is a public company, whether it is a private company, whether it is a sole trader, in order to check their finances, they prepare the financial statements in order to check how the business is running, in order to check what the business is worth, all of that, they need to prepare financial statements. Now, the companies which are public, we'll get to these, what are public companies, what are private companies later. But for public companies, it is an obligation for them to prepare the financial statements. They cannot get away with not preparing the financial statements. They absolutely have to prepare the financial statements. But companies which are private, or single owner companies, which are called sole proprietorships. So these sorts of companies, they don't have to prepare financial statements, but they do prepare financial statements in order to get an idea of how their business is actually working. So what basically are financial statements? You've got 3 major financial statements that we will learn in this course. The first one is called an income statement, right? This statement is going to tell you about how much profit or loss your business has made, over the last year, over the last 6 months, over the last 3 months. The second statement is known as the balance sheet. This tells you the worth of your business. Worth of your business would be what your business is worth on any particular date. Let's take the example of a car, for example, right? So if you have a car and you have given the car on rent, you have given it to a driver who drives it for Uber, you pay him a wage for that and he brings you the money, right? So the money that he brings you and the amount, for example, that you're spending on fuel and all that, that is going to be used to calculate your profit or loss, what the driver is bringing in versus what you are spending to keep the car running, right? So those sorts of things are going to come into income statement. What is going to come into the balance sheet is that the value of your car. For example, you brought the car for $35,000, right? This value is going to be associated with your balance sheet. What you are earning from this $35,000 is going to come into your income statement. See, and the last statement that is part of the financial statements is called the cash flow statement. Now, again, Zen, I'm telling you all of this in order for you to understand the holistic picture of what an accountant does, right? We'll get to all of this and it will become a lot more clear to you than it might be now. I can understand. I remember my days when I started accounting in the levels. You haven't done accounting in the levels, right?
No.
So I can understand when somebody starts from scratch.
Okay.
Okay, so is it clear now a little bit? Do you have some idea of what financial statements are and what sort of steps an accountant is taking? Do you have any confusion somewhere?
No, I understand.
Okay, cool. Okay, so we understood, we talked about these 5 steps. So let's just get to the first step, which is 45%. If you understand this, you understand like 80% of accounting, how you will record transactions. And I will try to give you very basic steps which you can follow to make your way through this subject. So let's talk about recording transactions. Okay, so the first thing is, what is a transaction? So a transaction is, yeah.
It's a transaction is between two parties.
Absolutely, you're absolutely right. Absolutely right. Between 2 or more parties. It can be between 3, 4, 5 parties as well. Like for example, an asset is owned by 2 different companies, right? 50-50%. And then a third party comes on to buy that asset from those 2 companies. Now there will be more than 2 parties involved, but at least there are usually 2 parties involved, right? And it's basically an event involving 2 or more parties, right? And that event can be purchase or sale or payment or receipt of cash or any other component. Okay, so the first thing that you need to understand is what a transaction is. A transaction is any event that involves some sort of a purchase going on, any sort of sale going on, any sort of a payment that you are making to somebody else, to some other company, any sort of payment that you are receiving from another company. Everything will come under the heading of transactions. What can be some examples? An example could be XYZ Corp bought inventory for $5,000. This can be one example. Another example can be the same XYZ Corp, for example, paid $50,000 to employees as salaries. Okay. Another example can be XYZ Corp took out a bank loan amounting to, for example, $10,000. So anything involving any sort of commercial activity that any business becomes a part of is a transaction. It is very generic. When we get to examples, you'll see. That's not the main thing. You don't even have to look at it properly to understand that this is a transaction. That won't be an issue. The issue arises, okay, So recording of transaction, let's just write the steps first. What you need to do here when you're recording the transaction. So the first thing that you need to do is you need to identify the transaction, right? Which is the first step. You need to see, okay, so this is a commercial activity. This is some sort of a purchase, some sort of a sale, some sort of a payment, some sort of a receipt of cash, anything of that sort. You have to identify that this is a transaction. Step number 2 is you need to determine the accounts which the transaction is affecting. So it's pretty basic. For example, if we look for this for $5,000 in cash, for example, right? So if we look at this first example, we understand that this company is buying inventory for $5,000 in cash. Now, by accounts, every single thing in accounting is based around accounts. When I'm writing inventory, the inventory has an account called inventory account. When I'm writing cash, cash has an account called cash account. Now you need to understand and you need to try to figure out that this $5,000 is going to someplace and is coming from someplace, right? It's going to, when XYZ Corp is buying inventory in this, the inventory account should go up or should go down? What do you think?
Inventory account will go up.
Would go up. Absolutely. It would go up by $5,000. And it's written that you paid for this inventory in cash. So the cash account should go up or go down?
The cash account will go down.
Down. So this is basically your second step. You need to understand which accounts are being affected, and then you need to understand which account is going up and which account is going down. So you're done with almost 30% of recording transactions if you've done these two steps. In the second one, they're saying that XYZ Corp paid $50,000 to employees as salaries. So when nothing is written, you will assume it is a direct assumption that you will consider cash, that it is being paid in cash. Sometimes it is not being paid in cash, it is being paid in credit, which we will get to later on. But when nothing is written, then you have to assume that the payment is made in cash. Now, for example, this second one, XYZ Corp paid $50,000 to employees as salaries. Now you see this word salaries, this means it will definitely have an account. The salary account. So when you're paying $50,000 to employees as salaries, your expense, salary is an expense, right? So for example, your salary account was at zero, but now you have paid $50,000 into the salary account. So salary account will increase or decrease?
Increase.
Raise 50K. And how are you paying that salary? If nothing is written here, you have to assume cash.
Okay.
You're paying the, okay. So the second account affected will be cash, and it will obviously reduce because you're paying out salaries by $50,000. Now the third one, the company took out a bank loan, right, for $10,000. Again, nothing is written cash or whatever. So you have to assume that the loan was taken out as cash. When we're talking about the bank loan will also have an account. You will write bank loan, and the loan, you had zero, the company had zero loan. Now they went to the bank, they asked for a loan, they got $10,000. Their loan has increased or decreased?
Increase.
Increased. $10,000, and they've got this in cash. Their cash has increased or decreased when they took out
Increase.
the loan? Increased. Both things have increased. Perfect. So this is the second step. Firstly, you need to identify the transaction. In the second step, you need to understand which accounts are being affected. The third step is you have to determine the type of account. I'll explain this later on. The fourth step is that you record it in the general journal and all that. Should we get to it now? No. Let's just understand what we mean by type of accounts. In the above three examples, we talked about how many accounts? We talked about the inventory account. We talked about the cash account. We talked about the salary account. What else did we talk about? Bank loan, and I think that's it. And the bank loan account. Right? If it gets too much, then please let me know.
Okay.
Okay. So in accounting, every single account that you will see hundreds of accounts, right? When we were on, every single account that you're going to see is going to fall in one of 5 categories. That's it. This is what makes the life of an accountant very easy. No matter what the name of the account is, it is going to fall under one of the 5 things that I'm going to write now. And the treatment that you have to do will be based on which of those 5 things the account falls in. It is very, very simple. Like I said, if you've done these 2 steps, you've done 30% of recording of transactions. The type of accounts. Let's get to the type of accounts. So there are 5 types of accounts in accounting. The first one is your asset account. Then you have your liability accounts. Then you have capital accounts. After that, you have got income account, and then you have expense accounts. Okay. So assets, what do you understand by assets? What do you think assets are?
And cash, and which can increase the value of the company.
Right. Which can increase the value of the company. So, but more importantly, which can bring future economic benefits. It's pretty simple. Assets are those things which are going to bring the company future economic benefits. That means future income, right? Economic benefits, in layman terms, you can call that income, right? So if we talk about these 4 accounts, inventory, cash, salary, and bank loan, what do you think your cash account would be? Would it be an asset?
Asset.
Perfect. And which other of the 3 accounts would be an asset? One of these 3 accounts is also an asset.
Bank loan.
No, not bank loan.
Inventory.
I'll tell you why. Which one, sorry?
Inventory.
Yes, absolutely. Inventory. Now, why inventory first? Let me tell you why inventory first. Inventory first, because when you've got inventory, you're going to sell that inventory off to customers, right? You understand what inventory is?
Yes, the item bought or manufactured by a business to sell to others.
Yeah, right. For future selling purposes, right? So that inventory, when you're going to sell it for any particular profit margin, it is going to bring in income for the business. So that would be an asset. It will bring future economic benefits. Again, the cash that you have got lying around in the business, you can go and buy more inventory from it, which you are then going to sell, and you can gain future economic benefits. If you don't want to buy the inventory, you already have got inventory, you can invest that cash in the stock market and get returns from there. So that is why cash is also an asset. When it comes to bank loan, now bank loan, when we talked about the accounts which the bank loan was affecting, we talked about it would affect the bank loan account, remember? And the second account that it would affect would be the cash account. This cash is your asset, as we have discussed above. The bank loan, what do you have to do with the bank loan? You have to pay it back, right? You have to pay the bank loan back to the bank. So the bank loan would basically be a liability account. Now let's talk about liabilities. Liability Accounts are obligations which we need to pay back, let's say pay back, right? Any sort of loan that you are taking is you need to pay that back. So that account would be a liability account. For example, you go and you, for example, in this example above, when we talked about inventory, I said that you bought that inventory in cash. Sometimes what happens, in fact, most of the time what happens is you go to your suppliers, you ask them, okay, I need $10,000 worth of inventory. And they tell you that, and you tell them that I won't be able to pay right now. I will be making the payment 30 days from now, right? So you have got the inventory and you haven't paid any cash. So the cash account is not decreasing. So what you do then is that you basically that is called purchasing, for example, on credit. Whenever you purchase inventory on credit, your creditors increase. Your creditors increase means, for example, that previously all the inventory that you were buying was on cash. You had zero creditors. But now the first time you have said to your supplier that I won't be able to make the payment, I will make it later on. So it makes no sense to reduce your cash by $10,000 right now because you have not paid, in cash. You will pay it later on. So there is something that you need to increase or decrease. So what you increase or decrease is your creditors. This is a crazy concept. You will understand this much better when we talk about the double entry system and what debits are and what credits are, because that will complete the whole picture. But as far as we are right now, do you understand what assets are and what liabilities are?
Yes.
Cool. So capital, all you need to know right now is that capital is the amount invested by the owners. You don't need to know anything else, but what you need to know is capital is the total amount of money that is invested by the owners. Then, once these accounts are done, you have got some accounts which will fall in the category of income accounts. Income accounts, this is very self-explanatory. Accounts which are income accounts. I mean, this is pretty self-explanatory. And expenditure accounts are basically accounts which are expenditure accounts, or these will include expenses incurred by the business. Now, for example, if we talk here, what do you think this salary account is? Is it an income account? Is it an expense account? It is an expense account. Pretty straightforward. It will be, the income and expense account will always be extremely straightforward. You won't have to worry about that. Okay. So once you have understood that, for example, what sort of account any particular transaction is affecting, and you have also determined what type of account, you have identified the transaction, you have identified the accounts which the transactions are affecting, and you've also identified what type of account are those accounts which the transactions are affecting. Then you need to understand this table. Let's just call it table of effects. In fact, we'll get to this later on. Let's just talk about the double entry system first. Have you heard about debits and credits?
Yes.
What do you understand from debits and credits?
That it in the ledger account there are two types of like sides. One is debit side, one is credit side.
Yep. And that is 100% correct. People always get confused in why for example, why the left side is called the debit side and why the right side is called the credit side. You don't need to worry about that. It's as simple as why when you're standing somewhere, your east is called the right and your left is called the west. Why is it called right? Or why is that called left? That makes no sense, right? So in the same manner, you don't need to worry even a single percent point about why the left is always debit and why the right is always credit, right? You just need to understand that the left will always be debit and the right will always be credit. Now, when we talk about the double entry accounting system, it's basically the foundation of accounting, right? The whole of accounting is standing on this system. And what this means is the system, what it suggests or implies is that every transaction will have at least two effects. One would be debit and one would be credit. Now, there can be more than two effects, but usually in 99.9% of that, not 0.9, but 99, 98% of the cases, there will be only be two effects, especially at the AS level of accounting. So this is the first thing. And the second thing is the debit side must, starting this, always equal the credit side. It's very basic. Your debit side and your credit side, the balance on your debit side must always equal the balance on your credit side. There can be no exception whatsoever. You will have to introduce later on fake accounts in order to balance your accounts later on. But the one thing that is for sure is that you cannot leave any account unbalanced. Every single account has to be balanced. The debit side, the balance on the debit side must always equal the balance on the credit side. Now let's, okay. And now let's get to the table that we were talking about. And after this table, we will do examples, and a lot of what we have talked about is going to be reconciled in that. Okay, so Zen, please remind me how many type of work accounts there are, total accounts, how many types are there?
Five.
Five, yeah, I actually wrote that. And can you please name them?
Asset, liability, expense, income.
Asset, liability, income, and expense. Excellent. And there was a third one, I remember, was that?
Capital.
Capital. Absolutely. Capital. Okay, so these are your 5 types of accounts. Let's create a rough table. And the effects we talked, there can be 2 effects a transaction can have. It can either have a debit effect or it can have a credit effect, right? We've talked about these 2 effects, the double entry system. Now, these are the rule of thumb. This was the rule of thumb, right? The debit side must always equal the credit side. If you remember this table, your life is going to be so much easy. For assets, whenever any account is increasing, like we talked about in our examples, inventory was increasing, cash was increasing, and you realize that increasing account is an asset account, you are always going to debit it. Always it is going to get on the debit side. And obviously the opposite would be if it's decreasing, it is always going to get on the credit side. In fact, let me just erase this and we can shift it a little bit so that it's easier for you to understand. Let's just say increase here and decrease in this column. So whenever an asset account is increasing, you are going to debit that account. Whenever an asset account is decreasing, you are going to credit that account. For liabilities, it is the opposite. Whenever liability account is increasing, for example, when we took out that bank loan, which was a liability account, we're going to debit the bank loan account. Credit the bank loan account because it was increasing. And whenever a liability account is decreasing, you're going to debit it. For capital, it follows the same rule as the liabilities. If it increases, you are going to credit the capital account. If it decreases, you are going to debit the capital account. For income, again, they follow the same rules. If the income of the business is increasing, for example, you're going to credit it. If the account is decreasing, any income account is decreasing, you're going to debit it. And if we're talking about expense, expense will follow the same rule as assets. Expenses will be debited when they increase and they will be credited when they decrease. So this is never going to change. This is something that is never going to change. So you understand now, once you have decided, recorded the transactions, first of all, you need to identify, okay, so this is a transaction. Then you need to identify, okay, these are the two accounts or three accounts. Mostly they're going to be two. These are the two accounts that are being affected. Then you need to understand and make yourself understand which account is increasing, either both of them are increasing, or which is increasing, which is decreasing. Once you have done that, then you need to understand what type of accounts they are. If they're an asset account, the increasing would go on the debit side, the decreasing would go on the credit side. And so on, the rules will follow. Okay, perfect. Now I think we can get to some examples now, because this is then the least stuff that you need to understand before we get to the general entries. Now we will do a few examples so that you can get some idea of, all of these concepts can be reconciled, because I can understand it can be a little bit too much.
I understood the concept.
Perfect. Sounds good. Okay, so let's just go through some examples and you can help me with them. We can do them together and I think we'll be good to go. So for example, look at this statement. Bought inventory for $1,000 in cash on January 5th, 2023. Right. So let's talk about this transaction now. What do you think is happening here? Which accounts do you think are being affected here? What are their types? Can you walk me through your thought process a little bit? Or do you want me to do this one and then we can do the rest?
Asset and cash accounts are there.
Okay. But don't go through the types. Don't talk about asset, liability, capital, income, or expense right now. The first step is the name of the accounts, not the type of the accounts. What are the name of the accounts which are being affected by this transaction?
Inventory account and cash account.
Perfect. So you are spot on with the first step. You have identified the accounts. Now, the second step is you need to tell me what is happening to inventory account.
Inventory account is increasing.
Perfect. Inventory is increasing. And what is happening to the cash account, do you think?
Decreasing.
Perfect. It is decreasing. Now, the third step is you need to identify the type of account. Now, what do you think the inventory account is? Is it an asset, liability, capital, income, or expense?
It's an asset account.
Perfect. And what about cash?
It's income.
No. See, don't think about, okay. So once you have identified if any account is increasing or decreasing now you don't, in the third step, when you're trying to determine what type of account any account is, don't think about it going up or going down. Just think that cash is written on the board. What do you think cash account would be for any business? Now, if they have cash, they can invest it later on, right? If they have inventory, they can sell it later on for profits. They can generate future economic benefits. Same goes for cash. If they've got cash, they can invest that cash in the stock market, for example, in their own inventory, for example, and that is going to bring them returns or dividends or some sort of income. So that is also generating future economic benefit. Anything that is going to generate future economic benefit would be what?
Asset.
An asset. Perfectly done. Okay. So now once this is done, now you need to understand and tell me, in fact, we talked about that table above, right? What would happen if assets increase and what would happen if assets decrease, whether it would be debited, whether it would be credited. Now you are telling me an asset account is increasing. what would be the treatment? Would this be
Debit.
debited or credited? Perfect. And how about here when it is
Credit.
decreasing? Perfect, sir. Perfect. Okay. Now comes the fun part and the final part actually, when you are making the general entry. Once you have done this, once you have made the general entry, you have recorded a transaction. You are done with the first step. This is 45% of accounting. Obviously, we'll do a lot many examples and it will get a lot more clear. But how do we make a journal entry? It's very simple. First of all, you're going to write the debit account. The account that is being debited is not the type of the account, not you have to take the exact name of the account. So you will write inventory account. And you're going to write the amount by which it is debiting in front of it. It was debiting by $1,000. You have to write dollars 1,000. Okay. And the account, then you have to write the account that is being credited, which is a cash account. You will write cash account and the amount in front of it. This is the format of how you record a journal entry. And when you do it hundreds of times, it is going to become, a walk in the park for you. Trust me. So let's just get to the other example. The second example is paid salaries amounting to $13,000 on a particular date. Aage koi bhi date they can write, that's not an issue. Now, in cash. Why I said when nothing is written, you have to assume cash, but let's just write it for the moment. Now, what do you think? The first step was you need to identify what accounts are being affected. What do you think is happening here?
Salaries account and cash account.
Perfect. The second thing is you need to tell me what is increasing and what is decreasing.
Salaries are increasing and cash is decreasing.
Perfect. Now you need to tell me what sort of account these are. Salary account and cash account.
Salaries expense.
And cash?
Asset.
Absolutely. Doesn't matter what's happening with cash. It is always going to be an asset account, which is why I'm telling you, you don't have to look at these signs or what's happening. You just need to look at the item in isolation. And then you need to think what that is. Perfect, perfect. Okay, so fourth step, an expense is increasing. What do you think the treatment should be?
Debit.
Absolutely. And when an asset is decreasing, what would be the treatment?
Credit.
Sorry?
Credit.
Credit, absolutely. You will credit that account. Now, it's time for you to make a journal entry. This is your table. Tell me what to write.
Salaries account.
Yes.
13,000 is being debited.
Perfect. Then?
Cash account credit 13,000.
Perfect. Absolutely perfect. And let's just go through one more example. Okay. Okay, so this is a good example. Let me just write this. Actually, I want to get through the paper pattern as well. Or we can, let me see, we can get to it in the next class. Do you have some idea about the paper pattern, how the exam
comes? I've seen the paper, but like I've not seen it properly because I have taken the class.
Okay, makes sense. I explain it to you. Just for delivery purposes for $26,000 That's it. Okay, so this is a different one, different for what we've done so far. What do you think would happen here? Which accounts do you think are being affected?
Motor vehicle account and cash account.
Absolutely. And why did you say cash? There is no cash written here.
Because we have to assume they're paying cash.
Yes, yes, absolutely. Perfect. Now, what do you think is happening to the motor vehicle balance in the company? Is it increasing or is it decreasing?
Increasing.
Increasing. For example, you had motor vehicles which had a market value of 100,000. Now you bought in another vehicle. Now the total amount of motor vehicles have increased, total value of those motor vehicles. So absolutely, it will increase. And about cash,
Cash would decrease.
decrease. Again, now number 3, what is the type? What do you think motor vehicle account will fall under
Asset.
when it asset? Why? Why have you said
Because
asset?
it can be used to generate profit.
Yes, yes. Income. Let's just use the word income instead of profit.
Oh,
And cash is what? What again?
asset.
See, many of these accounts, as we move forward, many of these are going to get repeated again and again and again, and it is going to become a second nature for you. But like I said, Zen, this subject, especially for someone like you who is a newcomer into accounting, it would take a lot of practice for you, to get smooth. And once you're smooth in it, you would in 2 to 3 months, maybe, or 4 months, then it will be like second nature.
Okay.
Okay, so we have decided this, and okay. So now just tell me the effects. What would be the
Uh,
treatment for motor vehicle account?
the motor vehicle will be debited and cash would be credited.
Absolutely, absolutely spot on. And how would you make the entry? What would you write now?
A motor vehicle account debit 26,000 and cash account credit 26,000.
Perfectly done. Okay, so now let's just touch on. I think then we'll discuss the paper pattern in the next class. Huh?
Okay.
Let me just discuss one little thing with you. For example, even in our individual lives, you see, you will have some cash in your wallet. Your
Yes.
father and your mother will have some cash in their purses, and some of the cash that you guys will have will be in bank accounts, right?
Yes.
In fact, most of it will be in bank accounts. Some of it you will have as cash. Same is for businesses. Some businesses have got some cash, and some of the cash is basically the same thing, cash, but it is saved at the bank. So the distinction between these two types of cash is known as cash at hand, cash that you have in hand, and the other account is cash at bank. It's very, very basic, right? So all whenever stuff like this is written, these transactions are written like this. They can end with, for example, purchase a motor vehicle for delivery purposes for $26,000. They can either write in cash, then you understand that you have to credit the cash at hand account. They
Okay.
can write, they can write at for example, they can write nothing, then you still can credit the cash at hand account. Or what you can do is, you can put a star in the question, and you can write assuming that this is being done from cash at hand, or assuming that this is being done from cash at bank, and then you can credit the account that you have assumed, right? If the examiner has not
Zubair,
told you anything,
कॉल आ रही
you
पापा
can
की.
write it like that.
जुबैर.
Are you there, Zen?
Yes.
Yeah, cool. Okay, so you understand the difference between cash at hand and cash at bank.
Yes.
So let's just do two last two entries related to cash at hand and cash at bank. For example, you get this in your exam: submitted cash into the bank, $800, right? So the first thing is, what do you think is happening here? Which accounts do you think are being affected here?
The cash in hand account.
Yes, cash in hand. And the second account?
Bank account.
Bank account, and you can call that cash at bank.
Okay.
It means the same thing. Okay, now number 2, what do you think is happening to cash in hand?
Cash in hand is decreasing,
Absolutely. And what about cash at bank?
increasing.
Yes. Number 3, what do you think the types are? Cash at hand and cash at bank.
Cash in hand is asset.
Yes, absolutely. Cash at bank,
Asset.
asset. It is cash after all. Doesn't matter if you put it in your first drawer or your second drawer. It is cash, right? So
Okay.
it is an asset. And number 4, the treatment cash asset is going down. What do we do then?
Debit. Credit.
Right. And when asset is going up,
Debit.
we do debit. So these are the short forms, right? You can write
Okay.
credit as CR and debit as DR. Now, again, this is a big debate because it makes sense why credit would be called CR because it starts with CR. But calling debit DR makes no sense because there is no R here. But just follow it, right? I don't know who did this. You'll have to Google that. But it doesn't matter. So when we're talking about the journal entry for this, we are going to debit cash at bank because it is increasing $800, and we're going to credit cash at hand again by $800. Right. So Zan, any confusion, any transaction, anywhere you still think there is some sort of obscurity, you don't quite get what's happening,
I
you can let me know.
understand.
You understood, right? Today's lecture you understood. Perfect. So then in the next class, what we will do is we will try to spend much more time on practicing these journal entries only.
Okay.
Because once you master this, then the whole of the other steps are going to come very easy to you. So you need to master this. We're going to try to spend the next class doing this
Okay.
only, and we'll try to discuss the paper pattern as well in the next class. What I would need from you then is that did you write all of this somewhere or
Yes, I have
did
written
you
the
not?
copy.
Perfect. So just go through this and try to redo all these things, all these transactions that we've discussed. And one other thing, then do you know what sort of books you are using? Can you please share your book with
Yes,
me
I
that you're
have.
using?
Yes,
Yeah, just share the picture with me so that I can arrange it for myself as well.
I have given to the person that I have in contact. He said to give it. I gave
Oh,
it to
okay.
him.
Okay. So I'll get in touch with him.
Okay.
Okay.
I have one
Great.
question.
Then it was, yeah, please go ahead.
When you write the journal entry, you have to write the credit first or debit first?
Always debit first.
Okay.
All, I mean, it depends. I mean, you can write the credit first as well. Like, for example, if we talk about this entry, we could have written it like, I'm just using a short form, cash at hand first as $800. But you will have to go back and write cash at bank $800, right? The debit will always be on the left side, and then there will be some gap, and the credit will always be after some gap. So it
Okay.
doesn't make much sense to write the credit first. You
Okay.
always almost write the debit first. Yeah.
I will give the picture in the group.
Yeah, the book picture, you can share that in the group, or if you've given it to the person that you were in contact with, so I can get it from him. No worries. No
Okay.
worries. Thank you, Zen. It was nice talking to you. Have a great day,
Okay.
and feel free to reach out if you get in any trouble. You can reach out to me over WhatsApp, and we can
Okay.
discuss.
Okay.
Right? Great.
Okay.
Great. Thanks, and bye bye. See
Okay.
you Wednesday.
Okay. Assalamu alaikum.
Welcome.